Hello, we're going to examine the output data from the B2T engine on the tax items of the deemed distribution from a controlled foreign corporation, or a CFC. In the US, the deemed distribution from a CFC is commonly known as the Subpart F income. In an entity group, certain passive income from a CFC is deemed to be distributed to the parent company, and the parent has a tax liability on that income. Further, this foreign income and the associated foreign taxes are also included in the parent's foreign tax credit calculation. In the US, many special rules are involved in such Subpart F processing. The B2T engine handles all that automatically, as long as the user maps his accounts to the standard account types. Here, we're going to use a simple example, a parent and one CFC child, to show the output data that are related to the Subpart F income. So here is our simple example where we want to calculate income taxes for a US company P that has a revenue of $1,000. Here in the input file, we also tell the engine that there is an entity group that's led by the company P. And we further tell the engine that we want to calculate taxes for this group as well. Now, calculating taxes for the group would trigger the engine to calculate items of international taxation, including the deemed distribution or the Subpart F income. Now, this input file by itself really has nothing international. So all the international items would be 0. Now, to make things a little bit more interesting, let's assume that there is a child foreign corporation of the company P. So we have another child entity, an entity CH1. That's a corporation, a Canadian corporation. And we wanted to tell the engine that P owns 100% child, so that P is in control of CH1. So we add in a relationship record that says P in this group is a parent of CH1 and the ownership is 100%. So therefore, P is in control of CH1 and CH1 is a Canadian company. So therefore, CH1 is a CFC of P. Now, let's further assume that CH1 has some passive income. So we go to the recurring input data. And we're going to add a trial balance record over here. So here we tell the engine that CH1 has a bond interest income of $200. So it is a passive income. But we need to tell the engine what exactly this bond interest income account is. To do that, we need to go to the setup input and add an account mapping record. So here we tell the engine that the bond interest income is mapped to the standard bond interest income, which the system then know it is a passive income. So that's it. Let's go to the recurring input sheet, and we're going to submit it to the B2T engine to calculate. Let's submit. Let's save it first. Save it. And we submit. So engine starts code. So we're going to wait for a few seconds before it's warming up. It's done. Let's open the output file. So here's the output file. We see the calculation for 3 of them, even though we specified only 2 calculations, one for P USA tax and CH1 Canadian tax, there is a intermediate calculation step to calculate CH1's USA tax. The taxes of this calculation is a shadow, so it's not part of the tax consolidation. It contains a lot of intermediate data that we will be examining. Let's focus on the P's USA tax. Let's go to the provision sheet. So here's a provision sheet. We see the current tax expense for P. And nothing special over here. We have $1,000 revenue, 21%. So we have the CTE, current tax expense before credit and everything, 210. Now, there's nothing international here again. Now let's focus the deemed distribution tax, which is Subpart F income. We know that P has a CFC, foreign CFC, in Canadian child, and it does have a passive income. Somehow it is not being reflected here. Let's see why. So let's go down to the report that tells the details of the Subpart F income calculation. So here's a deemed distribution. For USA, it's a Subpart F income. Now, it's nothing surprise here. The income, look at here, the foreign income is 200. However, the foreign income deemed distribution is 0. Why is that? So let's look at a note that the engine tells us. Well, essentially it says, okay, CH1, the income from the CH1 is too small. It is only 200, but the threshold is $1 million. So in other words, there's some kind of a de minimis rule that's in effect. It is too small, so there's no need to be included into the parent. So that explains why the Subpart F income is actually 0 over here for the current tax. For P. Now, if that's the case, then why don't we just increase the passive income of the CFC to be something bigger than $1 million, just to see how the calculation process is. Let's go back to the input file. So let's close this output file. And here's our input file again. We told the engine that it was $200 of this passive income of the CFC, so we changed that thing to be $2 million. Okay. So now it's $2 million passive income, and we're going to save it, and we're going to submit it again. Now it's down. So now let's open the file. So we go to the output file. Now this time we see a lot of big numbers. Remember, we have $2 million, so the numbers become very big. So we go to the P's calculation, the provision sheet for P, and to examine how the Subpart F effect is being reflected in the calculation. So current tax expense for P, we're coming down nothing, the current expense before the credit is this, so that's fine. Now, the Subpart F income here, the tax from Subpart F income is rather big. So how that's calculated? And let's go down again to the deemed distribution calculation, the Subpart F. Now there's a lots of large numbers that cannot be shown properly, so we need to expand this thing a little bit to further out. Okay, so essentially for CH1, there's a foreign income of $2 million. And the foreign tax, Canadian tax at 15% is this much. Okay, so the calculation goes like this. The foreign income tax is distributing the 2 million. However, there is a gross up from the foreign taxes 300K. So after the grossing up, the inclusion into the parent is 2.3 million. At 21%, you come down to the deemed distribution tax from that inclusion is about 483K. So that's the tax impact of the inclusion of the passive income from a CFC on the parent P. So we go up the current tax expense. The current tax expense, we're coming down, the tax effects of the deemed distribution is this much, 483K, we just calculated. Now we also notice there is a foreign tax credit. Okay, remember the inclusion from the CFC, that part of income is being taxed by Canada as well as by USA. So the IRS says, okay, to avoid double taxation, it is going to give P a break through the FTC, give the P some credit. And the credit looks rather small comparing to 483K. Why is that? So let's go to the FTC calculation. So here's the FTC calculation for P. Okay, we look at the individual contribution from each of the provision calculation, and the income falls into this bucket, the passive income, which is not surprised because we purposely put them into the passive income. Okay, now 2 million, now it's 2.3 million. Why is that? Let's look at the notes over here. It says the deemed paid foreign tax, 300K in the passive income bucket is grossed up to the CFC's income. So therefore 300K is added to the 2 million to make this foreign income larger than the 2 million. Okay, so that explains that. And for the passive income bucket, here is a detailed calculation down at the taxpayer level. So we have the foreign tax and we have the foreign income, which is grossed up, and the home tax is only 210 because the parent had only $1,000 in its home. The worldwide income for the P now is a lot more. It is 2.3 million plus 1,000. So that's the total. And we get a limit is rather small because the effective tax rate for P is rather small. So it is slightly less than 210. Okay. So therefore, out of all the foreign taxes that's currently creditable, only 209 can be used in the current period. The rest is being carried forward. And out of all the bucket, that's the final result. For all the foreign taxes, the IRS says you are limited to use only 209 for the current period. The rest has to be carried over. Okay. So let's go back to the current tax calculation for P. That's why the foreign tax credit is only about 209. And if we see the deferred tax calculation, we have the deferred calculation from carry forward. This is a rather large number. So most of the foreign taxes are being pushed into the future periods. So to summarize, in our simple example, We've seen that the B2T engine will automatically calculate the tax items of the deemed distribution from a CFC or the Subpart F income in the US. The user really only needs to map his accounts to the standard accounts for various passive income types, such as the interest income. And the engine will handle the rest automatically. That's it. Thanks for watching.